Good evening. Thank you so much for making time to join us for tonight's United Policyholders Roadmap to Preparedness and also Roadmap to Recovery program webinar on insuring your Colorado home, navigating today's challenging marketplace. We were originally going to offer this webinar just for folks who are still in the process of replacing their homes from the Marshall Fire, repairing, replacing. But because the challenges that are impacting Colorado residents all across the state, not just in wildfire impacted areas, have really continued to mount, we decided to make this a general Colorado home insurance shopping webinar. So welcome. We look forward to sharing up-to-date information with you on what's going on and how to navigate what's going on. United Policyholders, hopefully you all are familiar with us. But just briefly, if you want to follow along the slide deck tonight, this tells you how to do it. You go to our website, you go to events, you find this one, you go to the right, and then you can click on the link to the slide deck. You might have to scroll down a little bit to find it. It's now under past events. So for those of you who are not familiar with us, we're a 33-year-old 501c3 with a Platinum Guide Star rating and a national core of professional and disaster experience volunteers. My staff that's with us tonight include Amy Ludwig and Lisa Hughes, both of whom are Colorado residents who lost their homes in the Marshall Fire and joined our team. And it's great to have them. That's always been a big backbone of United Policyholders, is that we've always had people involved with our organization that either were working in the insurance industry and are now whistleblowers, or they retired and they have all this expertise that they're sharing, or they personally went through a disaster, learned some lessons, and now pay them forward to others. Or there are people who are in related fields that have a heart and mind to help the consumer and are involved with our guidance in our organization. We've been advocating for fair insurance practices and improving disaster recovery and resilience since 1991. We've been working in Colorado since 2010, since the 4 Mile Fire. We offer trustworthy plain language information and expertise on buying home insurance and navigating claims after a loss. We run 3 programs. And through our advocacy and action work, we are heavily involved these days in advancing solutions to the fact that home insurance has gotten very hard for people to find and afford and hold on to, and lots of related challenges that we are now all navigating together. So in addition to putting out guidance on how to get through the claim process, how to shop smart, we also are working very closely with public agencies, public officials, insurers, and a range of other stakeholders. We're closely monitoring the marketplace, working to restore affordable options, and then, of course, help people reduce risk, which is a key part of how we're going to keep homes and businesses adequately insured despite the national crisis. Today's expert panel includes myself, Bobbie Baca, Sarah Lucero, and Lisa Hughes. That's a little bit about me. I'm an attorney. I've been a professional insurance consumer advocate since 1984. I co-founded this organization. And those are some of my current engagements, working with the Department of Treasury, which is, of course, has a very strong interest in what's going on in the home insurance market, because it does have a ripple effect on real estate, on the mortgage industry, and all kinds of other parts of our economy. And then I do work closely with insurance commissioners around the country, including your commissioner, Mike Conway. So that's me. Bobbie Baca, I'm very pleased to have with us tonight. Bobbie is the Director of Property Casualty and Title Consumer Services at the Colorado Division of Insurance. We have been working together for many years to problem solve in the insurance space. I'm really grateful to Bobbie for sharing her expertise tonight. Also grateful to Sarah Lucero, a Colorado native and an insurance broker who has a very good attitude, which I would say is one of the most important characteristics to look for in an agent or broker today, is somebody who's staying positive, not drowning their sorrows in the local tavern or retiring. So Sarah, thank you for being with us tonight. And then we have Lisa Hughes, who is the United Policyholders Roadmap to Recovery and Roadmap to Preparedness Colorado liaison, and also a resident of Colorado in Louisville. And together we will be walking through some information and questions. Now, we do have the chat open for you tonight, but what I'm going to ask of all of you is that before you start putting a whole bunch of questions in the chat, give us a chance to answer them in the program. And then if we haven't answered your questions, we will leave some time towards the end to get some of your questions answered in the chat. But if you can be patient, that will help, because we tend to, if we see a lot of questions in the chat, it gets distracting. So thank you so much for your patience. So why are we here? A combination of factors have created this crisis, particularly in areas like yours in Colorado, where there have been recent large-scale disasters. So home insurance has become harder to keep and find and afford. A lot of the name brands that you see advertising on TV may not be an option for you. And there's a lot of things happening today that people describe as unprecedented. Many households are finding that their only option is to buy insurance through a company they've never heard of, or what's called a surplus lines or a non-admitted or excess insurer. So in insurance land, there's often three words to describe the same thing. So surplus lines, non-admitted, excess, kind of the same thing. It's a kind of an insurance company. It's different from the ones you're familiar with. Those are called admitted, fully licensed, fully regulated. Then you have this other kind. They're a different kind. They're insurance companies. They have solvency requirements, but they are less regulated. You do have a FAIR plan that's going to be coming available soon in Colorado. It's being developed, and I predict, based on what we know from other states, that as soon as the FAIR plan is an option, there will be new products that will come on the market to complement what it doesn't cover. It's going to be very limited last resort coverage. We'll talk a little bit about it tonight. My organization's guidance has heavily focused for many, many years on taking the lessons we learn after disasters about where people came up short on their insurance, and trying to help people avoid those gaps by buying the right amount of insurance. And the work we've done in the Colorado legislature with your division of insurance and some of your elected representatives has been focused on trying to get the products that are available to you as home insurance policies to really cover a total loss, because so many people were finding that their policies didn't. So after all those decades of focusing on helping people avoid being underinsured, we're now in a very different place where we are trying to help households find any coverage. You're not, we're based in California. We work across the country. Your market is in much better shape still than California. So a lot of what we're talking about here is what if, but we do know that there are a lot of problems that are developing, and that's why your FAIR plan is being created. And I really want to emphasize that one thing is that's happened is your risk profile is a big deal, meaning how an insurer sees you as a as a risk, right? And so improving your risk profile is very key to keeping affordable insurance in place. These are some of the reasons that you may not get a renewal offer when your policy comes up for renewal, when your current term ends. Most policies are a year. Could be your risk score. That's a new thing. Just like you have a credit score, now you have a risk score on your home. It could be your home's claim history. It could even be claims that a previous owner had. Could be the age and condition of your roof. Could be conditions around your home that they perceive as hazardous. Could be outdated plumbing, outdated electrical. Could be something they think is dangerous that they didn't know about, like a pool or trampoline. And some insurers are putting quotas on insurance agencies, like you can only give us 2 or 3 new customers every month, that kind of thing. And then of course, each insurer has their own business objectives in terms of the number of homes that they will insure in a given area. So what do you do if you're dropped, non-renewed? Same thing. Start shopping right away. Get help from an experienced, proactive agent, ideally local, who specializes in homeowners insurance. Understand the basics of what's most important to cover. Ask good questions so you know what limits, exclusions, and deductibles you can choose from. Keep good notes of your conversations with insurer representatives. Still do your best to insure your home for replacement cost value, what it would cost to put it back in the event of a total loss, including upgrades to comply with current building codes. And then we still encourage people to buy that extended coverage endorsement as extra protection, for making sure you have enough, right? Be prepared to make risk reduction home improvements. Like what? Updating your wiring or your plumbing, installing a moisture sensor, repairing or replacing your roof, addressing hazardous conditions. Maybe you have an old car sitting there that you might need to get taken away, that kind of thing. Why is this happening? Marketplace factors related to insurers' profit objectives, claim costs, shareholder and investor goals. So just business realities. Risk segmentation and what I call TMI, too much information, facilitated by technology, risk scoring systems, models, drone inspection photos, AI, resulting in severely reduced underwriting and rate increases. Basically, all this data is scaring insurers into thinking maybe it's not so profitable to invest in some areas. Increasingly severe weather events associated with climate change, and then factors that are tricky, like inflation. Early COVID supply chain interruption made a lot of prices go up, and we haven't really seen them come back down. A hard reinsurance market, we're not going to go into too much more detail about that. And then some of insurers' concerns about being allowed to charge enough rates. Okay. Those are some of the reasons that we're where we are today. How we're helping, education, collaboration, partnerships, heavy focus on helping individual households and communities take steps to reduce their wildfire risk. And then making sure that that information is getting communicated to insurance companies and then factored into the rate so that people are getting rewarded for the risk reduction time and money that they are investing in those risk reduction measures. We are spending a lot of time talking with insurers, trying to help them come back down to earth with us. And then we are supporting federal and state legislation to increase mitigation incentives and funding, grants, and all that. Okay. I know you want to hear from the panel. I'm just a couple more slides here on the basics. So despite limited options and high prices, be prepared, not scared. So get educated. You're doing that right now. Seek out a proactive, consumer-oriented agent or broker. Reduce or eliminate non-essential coverages where feasible, but avoid underinsuring your dwelling. Compare what premiums will be with various deductibles. Create a home inventory, store it safely, mitigate. Take steps to harden your home, create defensible space around your home, and then choose the best option available to you. I'm going to turn it over now to Bobbie to walk us through what are the rules in Colorado in terms of, can an insurer just say no to you as a customer, either as a new customer or when your policy comes up for renewal? Bobbie?
Thank you, Amy. Yes. So in Colorado, actually, recent legislation, 2023, requires the insurance companies to provide a notice of non-renewal 60 days prior to the expiration of the policy. That had been 30 days, and that was, again, in House Bill 23-1174. all homeowners companies have underwriting rules, and they are required to apply their underwriting rules consistently across any risk that is written. They could have specific clearance or defensible space requirements that some companies will steer, as you know, Amy kind of referred to, like a swimming pool or a trampoline in the yard. A lot of companies will steer clear of that. Some companies will write it. It really just depends on what their underwriting rules are. And in Colorado, we do have a regulation specific to, and a statute specifically to refusing to renew a policy that has been within a designated wildfire catastrophe area. And that is, they cannot non-renew the risk that specifically for the purposes of being near that fire and while a claim is still open. But they can, to ensure that they continue to write the risk, they can set out reasonable requirements as far as like mitigating your home, or mitigating the surroundings of your home.
So Bobbie, is it the case that they could, let's say you are a Marshall Fire survivor and you get non-renewed. So they wouldn't be able to non-renew you just because there was a wildfire in your area, right? They would have to say other reasons. Is that correct?
Correct. Yeah. So if somebody was in the Marshall Fire area and you suffered a loss, or it could have been a partial loss, a smoke damage claim, but you also had a water damage claim and a hail claim, they could non-renew you for those reasons, but they can't non-renew you specifically as a result of just the Marshall Fire.
Okay.
Colorado Fair Plan, as Amy touched on, this is coming. We're hoping that policies will start getting issued in early 2025, hopefully first quarter. It's intended to be a market of last resort. So it is not as soon as the policies are available, run out there and purchase a fair plan policy. You do need to have 3 written declinations from other companies to be able to even apply for a fair plan policy. They have to be purchased through a licensed producer. They are for high risk properties where there are no other insurance options, that nobody is writing them, and the coverages are very limited. Actually, in some circumstances, I think you would find that the surplus lines market would be a better option. So if you have 3 admitted carriers, as Amy was talking about, that decline your policy, but maybe there's a surplus lines company that will write it, you're probably better off with that surplus lines company, just because the coverages with the fair plan are going to be so limited.
And I want to add, as I said earlier, that United Policyholders has shifted our guidance. I mean, we still emphasize try to insure your home for its true replacement value. But in the past, we would have said, and you never want to go with a surplus lines insurer, and that has really changed because just like Bobbie said, for some people, you'll be better off with the surplus lines policy than you would say with the fair plan for various reasons, which Sarah can go into as well.
And Amy, I think that am I having audio issues?
A teeny bit.
Okay. Do you want me to? I'm going to go off camera just in case and see if that helps.
No, it's fine. It's really not bad. It's not
okay.
bad.
Okay. So policies within the on the fair plan, they do not include replacement cost coverage. They will be actual cash value policies, which is basically replacement cost less depreciation.
Actually, go ahead. Turn off your video. Go ahead. Let's see if that helps. Okay.
Okay. Coverage is limited on homes, on residential properties, to $750,000. There's no limit on the value of the property. So if you have a $1.5 million home that you can't find insurance, you can insure that up to $750,000 on the fair plan, which would be a primary policy, and then potentially find coverage that, as Amy was referring to, with another company that might come in and insure the other $750,000. The basic policy is fire and lightning coverage, with an option to purchase extended coverage. That extended coverage includes wind and hail, smoke, vehicles, riot, and aircraft. The policy does not include additional living expense coverage. It doesn't include contents coverage. It is a basic property structure policy. At this point in time, the rates are not yet available. They are working on those. We're hoping that maybe they'll be ready by the end of the year, which obviously the rates need to be in place before they can start writing policies. So that is coming. If you want more information on the FAIR Plan, Kelly Campbell, who is the executive director of the Colorado FAIR Plan, is going to be presenting at a Division of Insurance stakeholder meeting on Tuesday, October 29th at 2 p.m. You can go on our website and click to receive an invitation to or register to attend that stakeholder meeting, and Kelly will provide more information. Next slide. So Division of Insurance resources. We have quite a few resources on our website. Some of them we're working to update them, but we do have a premium comparison guide. So if you are shopping for homeowners insurance and automobile insurance, we are in the process of getting our 2024 data uploaded into the website. We have to wait on OIT to do that, but it is in the works. So right now it's still 2023 information, but you can click on a zip code in your area. We don't have every county and every zip code in the premium comparison, but we do try to have a good representation of the state as a whole. So look for that to see if there's companies that are writing and potentially what the premiums would be. Obviously, every house is a little different based on the premiums because you may be eligible for discounts that your neighbor is not, or if you had a loss and your neighbor didn't, you may have a surcharge. So there's can be some differences in that premium, but it'll give you a kind of a basic starting point. We have a homeowners insurance buyer's guide. It is also on that resources page. Looks like I forgot to include the link there. And then we also have a toolkit for homeowners on our website, which is a newer page that we've recently created that provides information on homeowners insurance products. That's also an HOA toolkit on there if you live in an HOA or if you are familiar or have questions about HOA insurance. Other resources, filing a complaint if you have any questions or concerns with regard to whether you think your homeowner insurer is shouldn't be non-renewing you, or you don't believe that they're the reasons for non-renewing you are valid, you're welcome to file a complaint with our office. One of my staff members, one of my team members would reach out to you, have a conversation with you. Sometimes it's just about educating, providing additional resources, options to shop around for other insurance. And sometimes it may be, yeah, we think that the company, we should go to the company and ask them for additional information and see what they're basing their action on. And that doesn't necessarily have to be just non-renewals. I mean, that's claim information, that's premium increases, that's anything that you have an issue or a concern with, you contact our office. And then again, more information on the homeowners insurance affordability and availability page. That 303-894-7490 number is directly into our consumer services team. If you hit option 3, you'll get somebody from my team. And the Dora_insurance at state.co.us is a general email box for questions. If you don't want to file a complaint, you can always email us with a question and we respond as quickly as possible.
Thank you. And I feel like I need to just interject a little dose of reality here. To those of you who have joined us tonight, and you may be thinking, and you may have gone through one of the many other fires in Colorado that our organization has responded to and helped with the long-term recovery process. And you may be, or you just may be a regular homeowner thinking, okay, this is outrageous. How could this be happening? how could insurers get away with this? And I just want people to understand that the there's sometimes things happen in our world that you didn't expect, right? We didn't quite expect how technology and climate change were going to sort of collide with post-COVID inflation to create sort of a perfect storm in a way. And I think we didn't need that. We always had competition. Insurers were competing for your business for years and years. And so there wasn't really a need for there to be laws, as many laws as we have for ensuring fair claim handling. There weren't as many laws that would tell insurers who they needed to sell to and not sell to. And we don't have that many rules in place. It's more kind of insurers kind of get to decide who they want as customers and not. And it wasn't a problem until recently. And now that we're in the situation where people are really struggling, and I know it's a very, very serious challenge for a lot of households these days to be able to pay the kind of premiums that they're being asked to pay. And I think it's very hard now because lawmakers are between a rock and a hard place, meaning they're trying to hold on to their markets. They're trying to keep they want competition. They want insurers to want to do business in the state. So it's very hard to come down on the insurers now and say, oh, now you're not allowed to do this and you're not allowed to do that. So we're in a very difficult situation here politically and legally. And that's why it's so important that we all commit to doing risk reduction, because that's one of the only ways we're going to get out of this. Because now that insurers have all this TMI, and they are for-profit actors, they're just acting like rational capitalists. So I just wanted to say all that so that folks in the audience wouldn't be going, well, this is just not right. It may not be right, but it is what it is. And so we are here to bring you the best guidance that we've been distilling, because even though Colorado is not California and what's going on in California is not the same, there are some parallels. We've been watching your state. We've been worrying about your state since, I think, probably Black Forest or Waldo, one of those fires, when availability, people started getting non-renewed, and we did start sounding an alarm. So this has been happening for a while. And I just want everybody to know that there's a lot of people working to fix the situation. I mean, to a certain degree, we're all going to have to be patient while we navigate these unprecedented times. Okay, so affordability strategies. Find out what discounts are available. Ask for those you qualify for. Bundle with one insurer, your hot car and your auto. Work with a proactive broker. Raise your deductible. But do it in a thoughtful way. I'm going to ask Sarah some questions about that. A high deductible will reduce your premium and you'll be less likely to file small claims, which is smart. But too high a deductible means that all your smaller claims are not going to be covered anyway, or even a medium-sized one. Reducing or eliminating buckets of coverage you can live without. We're going to talk a little bit more about that. So high dollar limits on contents or other structures. Again, those of you who've been through a total loss can't even imagine how could I needed every dollar that I had. So we are in a new world here, and we're doing our best to adapt, right? Mitigate, harden your home, create defensible space, don't file small claims. Sarah, let's talk a little bit about some of these affordability strategies. First of all, can most of your clients bundle? And talk a little bit about your agency and how you're helping people get through this.
First off, can you hear me?
Yes, we can. Now we can't. We did. Did you do something?
How about now?
Yes.
Okay. I had hit something on my phone. Yeah, now I'm seeing, even with current clients that I have, where their auto rates are increasing and they've got their home bundled with their auto, what we're telling people is just kind of stay put for a little bit, because if we move an auto away from a home policy, you're going to see 50% or more increase. And I'm already just seeing 50% increases on home rates. A lot of the companies that I work with, they are, come renewal, you will see probably a 1 or 2% wind and hail deductible. A lot of my companies that are where I'm putting new business with them, they're requiring a 2% wind and hail deductible. And what that means is whatever your dwelling limit is insured for, I'll use the example, if your home is insured for $500,000, you might have a 1% wind and hail deductible, which means you've got a $5,000 wind and hail deductible. Certain companies, like I say, they have a 2%. So that same $500,000 home that's insured for $500,000, you might have a $10,000 wind and hail deductible. So anybody that's getting new roofs, I ask, reach out to your agent, because when you file a claim, if you get a new roof and you have a hail resistive roof, claims department does not talk to the agency side. They don't talk to one another. So if you've got a new roof, things like that, please let your agent know so that they can update your policy. A lot of times when you get a new roof, it can help offset any kind of increase in premium that you have. Most companies do give pretty good discount on a wind and hail resistive UL4 hail resistive roof. So if you get something like that, or you've got a roofer who says, hey, we'll put a new roof on and throw that in, that's a great deal. Go for it. We had a bad storm down here May 30th, and I'm in Thornton area, and a majority of everybody on my block all got new roofs, and I insure some of my neighbors, so I'm already giving them fair warning that those rates are going to be increasing, and that we're going to have to probably look at a higher wind and hail deductible come renewal. So it's out there, it's already happening, and places in the mountains where we might not be able to get coverage with certain companies, if you're getting renewals from your carriers, I would stay with them. I know it's expensive, but there's things you can do to offset those costs by taking higher deductibles, reducing or eliminating coverage that you would be essentially taking care of self-insuring, just to help offset those costs. If you don't have detached structures, take it down to the bare minimum that the company allows you to have. Personal property, most companies will let you go down to 50% of your dwelling limit. So again, if you've got a $500,000 home, take it down to 50% of that. That's $250,000, and most companies are giving replacement costs on your contents as well. So
thank you so much, Sarah. I'm sure you have more. I just want to throw a question at you. I've had agents say to me, oh, well, you can reduce your other structures if they let you. Sometimes it's sort of, automatically tied and hard to take it out. But it's not really going to reduce your premium that much. What are some of the coverage reductions that are going to give you the biggest reduction in the premium?
I'm noticing even with like extended replacement costs, typically when I quote home policies or I offer, coverage for different home policies, I give you everything that they offer, and I can peel back some of the coverages that might not be important. Typically, if a company offers 100% extended, I'm going to quote you with 100% extended. But I have noticed that some of my companies, if you go down to an additional 25% or 50% extended replacement costs, that could be, $300 to $500 a year difference just by taking a lower extended replacement cost. And what that extended replacement cost is, which I'm sure, if you did your home in the Marshall Fire, if you weren't having those conversations annually, where you might not have had any type of extended replacement cost. I believe it's state law now, a state statute that insurance companies have to offer. I believe it's a minimum of 50% extended right now. So what that is that's additional coverage for a total loss on your home. So those are things you can talk to your agent about. Is there a big difference between a 25% extended, and that's 25% above whatever your dwelling limit is, or 50%? Because I'm noticing with some of my companies, it's a pretty substantial difference to go down to 25% above your dwelling limit.
Okay. And now have any of you, the companies, so you're an independent agent, you're a broker, right? So you,
I am. I'm
you
a broker.
okay. So, so you have different options you can put people with, right? Can you also put
Yes,
somebody with a surplus lines company or no?
I do. I do have surplus lines. I've got 3 or 4 different surplus lines markets. I will tell you, if you are in a position where you have to get insurance through excess and surplus lines, it doesn't do you any good to call several agents, because what happens is the first agent that gets it into one of an excess and surplus lines carriers, they block the market for anybody else. So if you've got an agent that you work with that you like, I would stick with that one agent, especially if they're responsive. Because if you call various agents, whoever gets that quote into that excess and surplus lines market first is going to block the market. So someone like me, and we've got RPS, Amwins. Those are my 2 top companies that I have excess and surplus lines contracts with. So if you're getting a quote from those types of companies, just be aware that if you're calling various brokers, you end up blocking the market. So whoever gets it in first is the one that gets it.
Okay, thank you. And are the companies that you that you sell, whose products you sell, are they starting to impose conditions like got to put in a moisture sensor? Are you seeing that?
I'm not seeing that a whole lot. What I am seeing is like homes in the foothills, or even not even in the foothills, kind of like out in the rural areas. I'm starting to see companies not taking those homes because of certain zip codes. They're asking for, obviously, properties to be mitigated. Boulder County has wildfire partners, and I've worked with them. They are great people. They've even got some great videos about mitigating property, mitigating your property. So yeah, I'm not seeing so much on the water sensors though, but definitely mitigating the property.
But you are seeing insurers say you got to replace your roof?
What I'm running into is people buying new homes. That's the first question I'm asking them. Are you getting a new roof? Because certain companies won't take your roof if it's over 10 years old. They won't do replacement costs. They'll make you do a payment schedule or depreciated value. That depreciated value could be on labor and materials, or it could just be on materials, which is a big difference when you're on a depreciated roof schedule. Some of my companies, it starts in year 1. Some companies, it starts in year 10, meaning your roof is 10 years old, not 10 years of being with the company, but if your roof is 10 years old, they're going to start depreciating your roof, which means you're going to be paying more out of pocket. You're going to pay your deductible and whatever they deem your type of roof. It might be 3% a year. It might be more, where they depreciate that. So you're paying more out of pocket to replace your roof.
I'm saying people are going to have some practice with math. That's a lot of math.
Yeah.
These were just some of the questions I want to just make sure we covered. Where should people not trim to save money, in your opinion, Sarah?
Extended replacement costs, because obviously when a catastrophic loss like the Marshall Fire occurs, immediately building costs in that area are going to skyrocket. So always make sure you have some extended replacement costs. I really would not get less than 50 if companies, if that's all that you can get, 25%, but I definitely would not skimp on that. Water and sewer backup, I would not reduce that, because that coverage, the cleanup alone, when the sewer line backs up into your home and causes damage to flooring, personal property, drywall, the cleanup alone can be as much as the cost to, repair the damage. Another thing that companies are offering, and it's super, super inexpensive, is service line coverage. The lines going into your home, your utility lines, that sewer line. Very inexpensive, less than $100 a year to insure your service line. And most companies give around $10,000 in coverage. I've got others who will go up to 12 or 20,000. So that's another coverage I would highly recommend getting. Obviously, ordinance and law, I believe we have to have 10%. But if you've got an older home that might have some older electrical, it doesn't cost a whole lot to bump that up to 20% of your dwelling limit for building ordinance and law.
Okay.
To make sure, even if a partial loss occurs, like a fire in the kitchen, let's say, and the electrical's out of date, it could be very costly to have your whole home rewired with new electrical from a partial loss.
And what discounts are currently available? What are some of the meaty ones?
Well, obviously the multi-policy discount, the more lines of business you have with a company, the more discounts you can get. I've got companies that if you get a measly little $100,000 life insurance policy, the cost of that life insurance policy can pay for the monthly cost of that life insurance policy. Is huge discounts off home and auto. Getting an umbrella, like the more business you have with a company, the bigger discounts you're going to see. So obviously multi-policy discounts are the best. Hail resistive roofs, telematics in autos. If we're not offering telematics, somebody else will. So you see these commercials with like certain companies where they've got the snapshot. I highly recommend doing any kind of telematics program you can get with your auto. That's going to save you a lot. So
that's letting them put a box in your car to track your driving.
Yeah, it's more now where you're downloading an app on a phone. I know a lot of people are like, I don't like Big Brother, but believe it or not, we are already being tracked through our cell phones without having an app on there. There's other ways that we're being tracked. So the discount really is pretty substantial among companies when you allow the telematics program, and usually it's about 90 days. And you can save money immediately off your policy. After the 90 days, even come renewal, your rates can be lower if you're, a good driver.
Yeah.
So.
Yeah. Bobbie, anything you want to add in answering any of these questions?
No, I would just add, you talked a little bit about the law and ordinance coverage. I definitely wouldn't trim there because it does impact partial losses as well as total losses. But it is actually now with House Bill 23-1174, the companies have to offer 20% for law and ordinance coverage. Now, you may still only purchase 10%, but they have to offer the 20%. And then I would say on discounts, I mean, you already hit on the class 4 hail resistant roofing. If you've had a hail claim and you're putting on a new roof, you're going to get a new roof discount anyway. But if you upgrade to a class 4 hail resistant, you'll probably get a higher discount. And the chances of you having another hail claim within the next 2 to 3 years are significantly reduced because that class 4 is supposed to withstand most hailstorms. Obviously the big baseball size hailstorms and that like Colorado Springs have had in the recent years and stuff may not withstand that, but the class 4s will withstand most hailstorms. So
so Sarah, in terms of like covering your car during a hailstorm, do any of the companies you write for require or suggest a particular type of a I know there's like those inflatable covers, there's different kinds of covers. Is there any kind of particular strategy for protecting your car against hail that the insurers that you write for suggest?
I'm actually not seeing a whole lot of that. Obviously, if we know a hailstorm's coming, get your car in, get it covered any way possible. Again, back on May 30th, we had a lot of cars that were damaged. A lot of insurance companies just didn't have the funds to be able to get these cars in, to get them fixed in a timely manner. So I had a lot of people whose cars got totaled out where there was nothing wrong with them. They just looked a little ugly from the hail damage. They were not getting salvage titles, which is good because they can still insure the vehicle with comprehensive coverage and collision coverage, even if the car is essentially totaled out. It's not a salvage title. So that's kind of good, good things that the insurance companies have done for people that I've seen. So
okay. So obviously agents and brokers can help you access options you can't find on your own. This is another one of those, this is the new normal. We used to, people were getting much more acclimated to shopping online, but now in this market, we're finding that the human touch is very important. Are
yes.
you, Sarah, are you finding that you have to spend more time? This is what a lot of the agents in California have been complaining to me about, is that it just takes them a lot longer to bind a policy for their clients. Are you experiencing that?
I'm experiencing some of that. Again, it depends on the situation where the home is located, if we're getting an auto with it. What I'm seeing is rates are not as competitive, obviously. But yeah, I used to be able to turn quotes the same day I would get them in, and it's taken me a minimum of 2 days to a week to get back to people, just because of the amount of people looking for insurance. And with me being a broker, I am the liaison between you and your insurance company. I've always been on the independent side. I like the independent side. And that's what I do for a living, is I shop your insurance for you, so you can enjoy life and not have to stress over that.
Yeah. So I mentioned earlier that, look, we all know about credit scores, but in the last, I don't know, 7 years or so, there's been a whole bunch of companies that have started up that sell risk scoring systems to insurance companies. So your home could, if they're using a particular type of a scoring system, it could be 1 to 30, or it could be 1 to 100. So whatever number gets assigned by that risk scoring program to your home is a big deal in terms of what options you're going to have as a consumer. And we're really in the early stages of requiring transparency, meaning requiring these risk scoring companies to tell you how they came up with your score, right? It took many years of fighting, and Congress eventually required credit scoring companies to give you a free copy of your credit report. And so you can see what's on there and what you're being dinged for and on rewarded for. We don't have that yet with risk scores. I don't know, Bobbie, I don't want to put you on the spot, but is the department, I think the department's sort of looking at this and thinking about what you want to do about it. Can you comment?
Yeah, I know we've some conversations with some actually, like one of your bullet points is taking in mitigation factors, and there are some newer modeling companies that are actually doing that, where they actually look at the property on a specific individual property level, and they do take into consideration mitigation of that individual property. But as far as right now there's no legislation. Like as you said, we're in the very beginning stages of this.
Yeah.
We at the division think that transparency is very important for the consumers. And if you need to, if you think your company has looked at the wrong house, or there's or something, file that complaint with us. That's going to be the best way for us to go back to the company and say, show us the information that you used to develop either the risk score or to make the underwriting decision.
Right. The classic example is an insurance company says we're not going to offer you a renewal policy because it looks like your roof is not in good condition. And then when you ask them, well, what, let me see the photos, or if you file a complaint with your state regulator, and then the insurer has to give them the pictures, and they say, oh, those are not damaged roof tiles. That's a solar panel, but the drone image or the satellite image just didn't pick it up right. So Sarah, are you having challenges for your clients with risk scores, knocking them out of the
Yes.
ability?
Yes, I am. As a matter of fact, I'm seeing it on policies that don't renew for 6 more months, where the insurance companies are asking, they're sending these drones out and they're saying, hey, we see a lot of debris in the yard. We're going to set this up for non-renewal unless we can get updated photos. Or they're doing it before, when I go into quote a home, if they do their little searching behind the scenes, and then if we want additional information, we can contact underwriting and ask them, why are we getting a decline on this? And then they'll tell us. We can see that there's, it looks like a bunch of cars in the backyard. So those things we can actually talk to the insured about. If it's a matter of not being able to see a fence line, we can explain those things. But yeah, I'm definitely seeing I'm seeing an uptick in people getting non-renewed.
Yeah.
Or a lot of questions being asked.
Yes. So this is a proposal that United Policyholders advanced last summer at a conference of state lawmakers from all over the country, and now it's kind of getting some legs. And a lawmaker from Massachusetts has introduced a version of it as a model, and I think you'll be seeing something along these lines in Colorado. It's basically just to give you, the consumer, that transparency to know what is the problem here, what can I do to fix it, and then give the homeowner some time to fix it, and then or correct errors, and then that wasn't my home, or you mistook something for something else, and then the most challenging part of our proposal, I think, is number 4, is requiring the insurer to offer a renewal policy to a consumer who submits proof that they've cured whatever defects or conditions were identified. So we're in the land of reality tonight, so we're not going to go into too much more discussion about what we want to see happen. Lisa, walk us through this slide, please. Thank you.
Oh, yeah. So, one of the things that's important, in addition to your personal level mitigation, is working with your community to get everybody as fire hardened or fire wise as you can, which is bullet. The first bullet, you can try to get a fire wise designation. I know there's people on here from all over Colorado. We do have some FireWise communities in the state. We're in the process of getting more. Just as an example, my community just got approved for FireWise from Colorado, and hopefully the national soon. And we'll be the first post-Marshall Fire rebuild community to get the designation. It's not that difficult, and we're hoping down the line it will help us keep our insurance. So there's a link there if you're interested in finding more about that for your community. You can reach out to me or go on the FireWise website, and it has a lot of really great information. Fire departments and public agencies are here to help you. A lot of fire departments are doing home assessments now. They're free. I would highly recommend having one. They can issue a report that you can give to your insurer, and hopefully that might help you get a discount or at least keep your insurance. And then if feasible, volunteer to help your community get widespread household participation in wildfire risk reduction. So it can be various different ways. Defensible space is pretty important. These are some pictures of various defensible spaces, but it's basically, for those of us, at least in the suburbs, you want to really make sure your 5 feet around your house doesn't have anything combustible in it. So you want to use like gravel or something like that, not mulch preferably, or like rock mulch, and then no plants in the first 5 feet. Non-combustible fencing, there's a picture of that. Cover your vents with mesh. You can literally go to Home Depot and buy 1/8 inch mesh and either put it on yourself or have someone do it for you. It's very inexpensive. Class A roof, I know Sarah already talked about that. It's also hail resistant usually. So hopefully you can get a discount and have a fire rated and hail rated roof. I think people can read that. That's about all I want to say on that. Some other things that are available in Colorado. This is not an extensive list. Fire adapted communities, wildfire partners, which Sarah mentioned, if you're in Boulder County, is a great resource. home assessments, county, local, regional programs, places like Grand County, Vale, et cetera, have wildfire councils. They're a great resource, Grand County Wildfire Council. There's one in multiple counties throughout Colorado. And then these are just some other things that you can do.
And I just want to say that, you know, wherever you go, you're going to see the same kind of list, right? Whether you're in Oregon, Washington, New Mexico, California, Colorado, experts have decided these are the things that make it possible for firefighters to save homes and that reduce the chances of a home getting damaged or destroyed in a wildfire. So you're going to see the same list pretty much everywhere you go. Anything else you want to say about this list here?
No, just that in that home ignition zone picture, if you're in the suburbs like I am, the farthest green line doesn't really apply to you because we're so close together that we don't have 30 feet between our houses. So the 0 to 5 and the 5 to 30 is the red and the yellow on there, is really the most important and critical for ember spread, reducing ember spread.
So I want to give a little time check here. We're at the hour. I was kind of hoping that we'd make it almost through the deck in an hour and then have 10 minutes for questions. So if you can just hang in there with us for a little bit more, we're going to get through the rest of the material, and if there are some questions, you know, give it a few minutes to answer them. So thank you for your patience. Okay, back to you, Lisa.
Oh, yeah, so we already talked about wildfire partners. They're in Boulder County, but many of the wildfire councils and fire departments across the state have used their sort of guidance and home assessment model to do the ones they're doing now. And they pretty much they work in West Boulder County with assessments, but they do work in East Boulder County for other things. This community assessment is what my neighborhood went through, to do the FireWise designation. And they do have, some insurer engagement for renewals, not in the East County yet, but we're hoping that that's coming. They have a great website full of information. And in the West, if you're in West Boulder County, some people have gotten, discounts for doing the reduction and kept their insurance for doing their things. They also had, a house that had done a bunch of mitigation that survived the recent fires that had done a wildfire partner mitigation.
And I want to say something about wildfire partners, it's a little, you know, little optimism here. When I launched a working group in California, I think 6 years ago now, when our market started getting pretty crazy, we decided, okay, fine. The insurers say the reason this is happening is because climate change has increased wildfire risk. Okay, risk is increased. Let's do everything we can to reduce risk. And when we were looking around at programs, we saw wildfire partners, and we learned that they actually were reversing insurance company decisions. In other words, if a home had gone through the program, the insurers that are participating were agreeing to renew those homes. And that was kind of the seed of a lot of the work that's going on in California and also in Colorado, is that we've seen that we can influence insurance companies' decisions if they believe that the risk has been reduced. So it's just a very important kind of piece of this puzzle, is getting this work done so that so that insurers can restore their confidence. So Lisa, back to you.
Sorry, I muted myself. I kind of already talked about this, but if you're interested in getting a home assessment done to see what work you might need to get done, you can check with your local fire department, or wildfire council. These are just some local ones to where I am. Boulder Fire Rescue. Oh, Wildfire Partners also is offering a rebate right now that expires at the end of the month if you're in Boulder County. If you do some mitigation work, same with Boulder Fire Rescue. And there's others across the state that I know are doing them. So your local fire department or wildfire council, are good places to start to find out who you can get a home assessment from if you're interested.
And if you don't remember anything from all of this, just remember, get in touch with your local fire department and ask them if they have any programs in place, or they know of any programs in place for helping households with risk reduction. Again, this is just more good information that Lisa pulled together from the different entities. Anything you want to add here, Lisa?
No, just that it's, like I said, it's not an extensive list. So if you have others and you're in another part of the state, let me know so I can keep track.
Great, thank you. So yes, it's worth it, even if your lender isn't requiring you, meaning if you own your home outright and there's not not somebody telling you you have to keep insurance. I think since our audience is heavily people who've been through the trauma of having to put the pieces back together after a wildfire, you know that insurance money, not charitable or government aid, is the #1 source of money that helps people rebuild and recover. FEMA money is needs-based. The max grant is $42,000. The average grant is $5,000. SBA loans are low interest, but they have to be repaid. And charitable aid is important, but only generally covers basic needs, not the cost of rebuilding a home. You know, it's getting a little late, so we're gonna zoom through these pieces. There are 4 main types of insurance companies, right? Admitted license, those are the ones you know, State Farm, Farmers, all the ones you see advertising on TV. This second category that we've been talking about tonight, non-admitted. The third part, Fair Plan, government sponsored. That would be the National Flood Insurance Program, Colorado Fair Plan when it comes online. And then the type of insurance that a lender can force place. So if your insurance lapses, let's say you get a non-renewal notice and you don't do anything about it, and you're now have no insurance, but you have a mortgage, your mortgage company is going to force place a policy, and you really want to avoid that. Force place policies are very expensive. They basically only protect the lender. They do not protect you. So really want to avoid that. And then you can go to our website and learn more about those types of companies. Again, these are the ones that you'll know. Bobbie, are you worried about the fact that these non-admitted companies don't participate in the Colorado Guarantee Association?
No, I don't think so at this point, although the amount of business that the surplus lines companies are writing right now is I think like 5-fold. It's like 5 times the amount that they've ever written. They're taking on a lot of business. So I wouldn't say worried at this point. I would say we're just aware.
Mm-hmm. Okay. And I want to go back, actually, let me just say one thing. The most well-known non-admitted insurer would be a Lloyd's of London company. And, you know, I don't want to be too cavalier about it, but I mean, they have money. It's not, you know, the ones I worry about are the ones in Florida that are startups, and they're really, you know, I don't want to say flimsy, but I did say flimsy. So that's what I worry about more, and I don't worry about it in Colorado. I think you have a very good, strong regulatory agency, and I'm less worried about that. So yeah. What matters? We talked about that replacement coverage over ACV. We went through all these extended replacement coverage, building code compliance, adequate dwelling ALE limits. If you have collections and things that are subject to an internal limit of policy, you want to get extra coverage for those. You want to know what's excluded and limited in your policy. And you want to know what the deductible is. It sounds like multiple deductibles now are going to be more the norm. No matter which insurer you end up with. Lisa, do you want to cover this one?
Sure. I mean, the most important thing is to keep your dwelling covered for as much as you can afford to do it, preferably to the cost of rebuilding. And this, I know the department's going to start putting out a list of their construction costs from a legislation that got passed a couple years ago. But yeah, try to get some estimates from builders about what the actual costs of rebuilding are, because it likely is a lot higher, especially if you're in a rebuilding area, than you think it actually is. So
These are just some questions to ask. when you're shopping for insurance. And remember, as Amy has been putting it in the chat to remind you that this slide deck is already available on our website. So the recording of tonight's program will be available. So if you miss something, you'll be able to watch it, listen to it again, and then you'll be able to reference this list. An ask from me and my team: please help us continue to monitor and contribute to solving Colorado's property insurance situation by taking a survey that we have open. It shouldn't take you more than 5 or 10 minutes. So thank you for that. The data that we're collecting will help us help you. We've been doing webinars like this on a regular basis in California about every 6 months or so. We are planning to do that for you as well in Colorado as your market shifts and changes, especially after your FAIR plan comes online, and we'll see how that affects the market and your options there. And a reminder, our organization is here for you, the consumer. So when we say we've got your back when insurance matters, we mean that that's what we are here for. We don't sell anything. The information that we put out is free of charge, and it is focused on you, the consumer. We are here to give you the nuggets of wisdom that are going to help you make the best decisions for your household. And that's what we're here, and that's what we're about. So Amy, I don't know if you've opened up the chat.
The chat is
Yeah, you
open
did.
and
Okay.
we're getting a bunch
Yeah.
of
So
already.
we're going to just take a few more minutes here and just say, I want to say a huge thank you to both Bobbie and Sarah and Lisa, both, okay, all three of you, for participating tonight in this webinar. I think I like to see all of us as sort of arms linked and trying to keep moving forward here together through these uncharted waters. So Anne Brennan asks, can you point us to any reports or information about Colorado insurers starting to recognize mitigation in their coverage and rate decisions? Are there specific programs companies are recognizing, such as Firewise? I can answer what I know, and then I would ask Bobbie and Sarah if they can add anything. So Firewise USA, it is a national program. You heard Lisa mention it, and we gave you the link to their website. And it's a program. It's actually not that hard for your community to get that designation. You have to apply for it, and they will put you through a certain application process, and then you'll hopefully get that designation. It's something I know, at least in California, that USAA has been recognizing it and giving anybody who lives in a Firewise community automatically a 5% discount. I think other insurers are consider it a legitimate indicator of improved risk conditions. Bobbie, Sarah, anything you want to add in answer to that question about insurers recognizing mitigation?
Well, yeah, I mean, we know that some companies, or at least from an underwriting perspective, companies are using like the Wildfire Partners or Firewise to help determine whether they're going to write the risk. As far as rates go, we're monitoring that. We're starting to track it a little bit more. We are not there yet. We can't. We don't know that if they're going to offer. What we'd like to see is them offer discounts for mitigation, or lower the rates for homes that are that have mitigated, but we're not there yet. We're just in the beginning stages of tracking that information, so more to come.
Thank you. And thank you, Dominic, for correcting the link for the meeting on the 29th, the public hearing on the FAIR plan. So you can see in the chat that there's a better link for that. Bonita asks who funds our organization. So we do not accept funding from insurance companies. We are primarily funded by grants from foundations. We have some funding from the Boulder County Community Foundation. We have funding in California through the state. We are working on lining up more funding to do this kind of work in Colorado. And then we do a fundraiser every year. And those are the primary ways that we are funded. Sarah's contact information is definitely available. In fact, I think in her slide, there was the name of her agency that she works for, Risk Management Partners in Wheat Ridge, right? Is that right, Sarah? Wheat Ridge?
But Sarah, if you could put it in the chat, that'd be wonderful.
Sure.
Otherwise, I can send it out and email everyone.
Okay. Yeah, we're not going to get, oh, we might get to all these. Okay. On the Boulder $500 fire hydrant program, does that apply to new construction? Lisa, do you know
Want
the
me to
answer?
take that? The answer is yes, but the work had to have been done between June 18th, 2024 and the end of this month. So, like if you got a non-combustible fence in that time period, then you can, my understanding is yes, you can submit for that. I mean, for the junipers, you wouldn't have removed them necessarily to show that you could have new ones. But if you did like, gravel around your house or something like that, you could use that to potentially get the $500. Yeah. It's up to $500. So, and I believe there's more information on the Wildfire Partners website about that.
Okay. Okay. Benita asked if fire assessment people come inside the house. I don't believe that they do. No.
No.
No. Okay. All right. We are Marshall Fire Rebuild, close to the 1-year renewal period. If we know more now and want to change insurers, will we be penalized for switching? That's a really interesting question, right? We, over the years, would say, we would be curious. So if somebody would complain their heads off about their insurer and how they behaved, and then they would not change, and we would be intrigued by that. And now we're kind of like, yeah, maybe don't rock the boat. Sarah, do you want to take that one?
Yeah, no, it doesn't count against you necessarily. Your insurance score, it can impact your insurance score if you're moving companies every single year. It just, if you stay with your company, you get longevity discounts, but those discounts will eventually go away, when you've been with a company for 5 or 10 years. Sometimes it's good to leave the company, get insurance with a different company for a few years. You can always go back. That's the other thing. If you're diehard certain insurance company, sometimes it does pay off to just go away for a little while and you can always go back. So it doesn't hurt you, but it can hurt you if you're constantly switching carriers every single year or every 6 months, especially on the auto. That can hurt you.
Okay. One helpful trick for my agent, game their company's internal estimate system to add things like crown molding to create rebuild values for coverage that match. I'm not sure I understand that. Maybe, Bobbie, if you want to read that one from Richard Johnson, and if you think, can parse that, will the state of Colorado send out notice when the construction cost data is available? I think the answer to that one is yes. Bobbie, is that right?
Yeah, so we will post the construction cost data on our website, and then the insurance companies are required to provide a link to that report in your policy renewal. So that information will be available. I don't know if we will send out a specific notice to consumer or an advice. We probably will. We'll probably send out an advisory notice like we do other type advisory notices, just letting everybody know that it is out there and available. But we are putting the onus on the companies to provide the information from that report and the link to where it's going to be at on our website.
Okay. This is another good question from Melissa. What are some of the sources of data that insurers use to assess risk? And are they available or searchable for consumers? That's a really, really good question. So there are a lot of companies that are providing data to insurers. Like Red Zone, I think, is the one that Wildfire Partners has been using. There's a company called Fortress. There's all these companies now that are that have software and all kinds of models and tools that they are using for consumers themselves. For homeowners, Lisa, are you familiar with any of the assessment are there private assessment companies that people can bring in?
You mean to do a home assessment?
Yes.
I don't know of any personally in Colorado, but that doesn't mean they don't exist. I mean, a lot of the like fire departments and stuff are using a software program that generates a report. But no, I don't know any of those. I think there are actually, I do know of one independent lady who is doing home assessments, so I guess there are some, but
There are a plethora of them in California, so I can assure you it's coming your way. In fact, there are almost too many of them. It's
yeah.
kind of
Well, I don't know if Ember Defense does them, but they're here now, and there's some other
there's
places. Yeah.
there's Allied Defense. There's a lot of them. Okay, Jennifer asks, we now have a full replacement policy now with Country Financial. I'm wondering what the pros and cons are with the full replacement versus a fixed contractual amount. I'm not sure I know what you mean by that. I would just stick with that. If you have that policy in place, I would just hold on to it. That's basically the guidance, right, Sarah? Hold on to it.
Yeah, yes. Country Financial, I believe they have guaranteed rebuilds. They might still offer guaranteed rebuilds. You might want to check with your agent and find out if your policy has extended replacement costs or guaranteed rebuild, also known as an uncapped limit. That's the best coverage you can get, and a lot of companies that used to offer that are no longer offering it. So I would definitely reach out to your Country Financial agent and find out if you've got guaranteed rebuild or uncapped limit on your home.
Very good. Okay. And Richard, thank you for clarifying. I think now I get your question. So with underinsurance, when we've been struggling over the years to try to figure out how do we fix this? Because why do insurers continue to underinsure? And we've learned part of it is that they're using a feedback loop from lowball rebuild estimates, then go into lowball replacement estimates, and their estimators are flawed. So I think what Richard is saying is, in order to really, if the insurer says no, that's the dwelling limit we're recommending is the right number, and you don't think it's enough, he's suggesting that you go really
Beef
detailed
up.
about the
Yeah,
descriptions.
beef up the replacement.
Right.
Exactly. Beef up the replacement cost guide. Now, most of my companies will allow you to go 50% above that replacement cost. So if your replacement cost is coming in at $400,000, they'll allow us to put an additional $200,000. I just issued a policy today for that same reason. But I am seeing that the cost per square foot with a lot of the carriers, they have updated those replacement cost guides. And I can do replacement cost guides for anybody. If you want to know a minimum amount for what you need to insure your home for, all I need is your address, and I can go pull in as much information as possible and send you what I recommend you should insure your home for a minimum for.
Okay. We are going to take the very last question from Ann Brennan. What language should we be looking for in our policies to ensure that extended coverage would apply to a purchased replacement home instead of a rebuilt replacement home? We rebuilt after the Marshall Fire, but we'll never rebuild again. So the law now in Colorado is that you are free to use your replacement cost benefits that you would have been able to use to rebuild stick for stick, board for board, the identical home, and take those same amount of benefits and apply them towards a purchased home or a rebuilt elsewhere home. So you already have that right. And I don't, in the law in Colorado, I don't think that that you need to really worry about that language in the policy. Bobbie, anything you want to add on that?
No, you're absolutely right, Amy. With that law change, that coverage is there. I would just make sure you actually have purchased the coverage. So, they have to offer the 50% extended replacement cost, and make sure you've actually purchased that. But if there were a total loss, again, and we pray that won't happen, but if there were a total loss, again, you would be able to go out and purchase a new home and still recover those. Let me back up a minute. So that is as a result of a catastrophic wildfire. If it's a total loss as a result of a catastrophic wildfire, then the coverage is you get the full policy coverage. If it were a single home total loss fire, then your policy limits are going to apply. So, so there is a distinction between the wildfire, the catastrophic wildfires, and an individual home being lost. But in a marshal fire situation, you would be able to go purchase a home elsewhere.
So, okay. So one of these folks is another person is saying that their policy was telling, or I guess the insurer is telling them that they would only get ACV if they decided to buy another house instead of rebuild. That they can't do that in Colorado.
No, not if it's as a result of a wildfire disaster.
Okay, so but if it was a one-off fire, they could,
It depends on the policy language.
right?
Yep.
Okay. Well, with that, I want to say again, a huge thank you to our guests, Bobbie Baca and Sarah Lucero, our experts. I want to say a huge thank you to Amy Ludwig for the tech, and Lisa for contributing to the program. It's been it's just an honor to be able to bring together this information, curate this information, and present it to you tonight. We really appreciate all of you who stayed on through the end. We often don't get to every single question, so thank you for bearing with us there. We will get this recording up as soon as we can on the website, and certainly are working on being able to continue to offer this type of webinar to you going forward. As things continue to shift, I think you have to be confident that you have a very hands-on pro-consumer regulator in Commissioner Conway. You have us, you have FACO, you have lots of hands on deck here trying to learn from other states, especially California, what we've done and well and maybe not as well. And I wish all of you a safe evening, some comfort to know that you have United Policyholders watching the situation very closely and doing everything we can with our partners in Colorado to help you navigate it. So with that, we're going to end tonight's webinar. And thank you all for your time and attention. Good night.